People have a habit of assuming tomorrow will behave just like yesterday, simply because it's easier than facing change. But the market doesn't wait for anyone's comfort. When conditions shift, they do it quietly at first, then all at once, and anyone still clinging to old assumptions finds themselves standing on ground that isn't there anymore. What's happening now isn't just another ripple or a passing phase. It's a deep structural change that most investors haven't bothered to understand. They're too busy feeling reassured by familiar patterns to notice those patterns stop telling the truth. When the environment changes, every lazy conclusion becomes a liability. If you want to stay out of trouble, you need to think without nostalgia, without wishful thinking, and without the childish belief that the world will slow down until you catch up. The shift is underway, the pressure is building, and the people who ignore it are about to learn a lesson the hard way. The shift happening right now is exposing assumptions people didn't even know they were relying on. That's the problem with comfort. It builds invisible habits. People start believing their judgment is sharper than it actually is because the environment quietly supported their mistakes. When conditions change, those mistakes show themselves instantly, and suddenly everyone looks far less competent than they assumed. The market has a way of rewarding sloppy thinking during easy periods. Investors confuse convenience with wisdom, momentum with insight, and stability with foresight. But when the underlying dynamics shift, all that sloppy thinking gets dragged into the light. The change doesn't create new flaws, it simply reveals the ones people ignored. One major assumption being exposed is the belief that things will always revert to the familiar. People assume cycles repeat cleanly because it makes them feel comfortable. But cycles don't care about comfort. When the environment transforms, old patterns stop functioning, and those who depend on them are left without a map. Another lazy assumption is that strong performance guarantees future resilience. People forget that success often hides fragility. They treat good results as proof of good reasoning, when half the time the results were pure luck. The current shift is revealing who actually understood their decisions and who just got carried by a forgiving market. There is also the assumption that diversification protects everyone, always. That belief is convenient, but it isn't true. Diversification works when risks are independent. When the structure of the market shifts, independence disappears. People are now discovering that owning many things isn't the same as being protected. Another exposed assumption is that liquidity will always be available when needed. That's one of the most expensive fantasies investors carry. Liquidity disappears precisely when people need it most, and this shift is forcing people to confront that reality. You don't realize your exit is blocked until you try to use it. People are also learning that optimism isn't a strategy. It's a mood. A mood is not dependable. A mood doesn't protect capital. The shift is showing how quickly optimism evaporates when conditions stop cooperating. Reality doesn't negotiate with moods, no matter how uplifting they feel. Another dangerous assumption being unmasked is that complexity equals intelligence. For years, complicated models and elaborate narratives made people feel smart. But the new environment punishes anything built on fragile logic. Complexity collapses under pressure, and that collapse is happening right in front of them. There's a quiet lesson unfolding. Most investors relied on narratives, not numbers. Stories made them confident, stories made them bold, but stories don't hold up when a market regime changes. Numbers do, and numbers are now contradicting the fairy tales people convince themselves to trust. Another lazy assumption is that risk is something you can measure neatly. People treat risk models as if they're physics. They're not. They're guesses wearing a lab coat. When the environment shifts, those guesses break down immediately. The models look scientific right up until the moment they fail. People also assumed they could adapt quickly if conditions changed. That's another myth. Adaptation requires preparation, and most investors did none. They thought they'd have time to react, but real shifts don't announce themselves politely. When change arrives, it moves faster than people's ability to adjust. A particularly costly assumption is that crowd behavior reflects safety. When everyone agrees, people feel secure. But widespread agreement often means widespread misunderstanding. This shift is exposing that the crowd wasn't wise, it was simply loud, and loud crowds make terrible guides. Another assumption being demolished is that debt is harmless as long as things go well. Debt doesn't hurt you in good times, and that's why people underestimate it. It hurts you when conditions shift. And the shift happening now is showing exactly how unforgiving leverage becomes when the wind changes direction. People also assume that certain industries or companies were untouchable. They convinced themselves that some businesses were immune to downturns. Nothing is immune. The shift is demonstrating that even strong players can feel pressure when the underlying structure moves beneath them. One of the most stubborn assumptions is that experience automatically translates to insight. Experience only helps if it's interpreted honestly. Many investors spent years accumulating habits, not wisdom. The new environment is clarifying that distinction with brutal efficiency. People assumed stability was proof of strength. Stability can be a sign of strength or a sign of sedation. It can mean things are healthy, or it can mean nobody is paying attention. This shift is exposing which stability was real and which stability was a pleasant illusion. Another false belief now collapsing is that past problems teach people permanent lessons. They don't. People forget fast. They rebuild the same illusions because illusions feel better than vigilance. The current environment is reminding them again that ignoring lessons makes lessons more expensive. A hidden assumption being exposed is that risks are always obvious. They're not. Most risks grow in silence behind comfort and confidence. When the foundation shifts, those silent risks become visible all at once. People mistake sudden visibility for sudden creation, but the risks were there the whole time. One assumption the shift is destroying is the idea that you can outsource thinking. People relied on commentators, influencers, analysts, and social proof instead of using their own judgment. Now, the consequences of borrowed conviction are becoming painfully clear. The final assumption being stripped away is the belief that the market will politely warn you before changing direction. It won't. Real shifts happen quietly, then violently, and the people who relied on lazy assumptions are about to learn that the bill always arrives, and it never arrives gently. The cracks always start in places people consider too minor to matter. A small discrepancy, an unusual pattern, a result that doesn't quite match the story. These are the early fractures, but investors ignore them because they'd rather believe the comforting narrative than confront the uncomfortable truth that something is slipping beneath the surface. One crack that's becoming obvious is the widening gap between reported optimism and the actual numbers. When the tone sounds stronger than the data, that's not confidence, that's choreography. People pretend not to see the mismatch because acknowledging it would force them to rethink assumptions they've grown attached to. Another crack shows up when forecasts become suspiciously uniform. Everyone starts predicting the same rosy outcome, using the same buzzwords, and leaning on the same justifications. Consensus feels safe, but when everyone shares the same belief, it usually means they're sharing the same blind spot. A dangerous crack appears when people stop questioning valuations. The moment someone says, "That's just how things are now," you can be certain they've stopped thinking. People accept inflated expectations because challenging them would feel like admitting they were wrong earlier, and egos prefer fantasy. One of the more subtle cracks is the shrinking difference between good businesses and bad ones. When everything is priced as if it's exceptional, that's a sign the market has lost its ability to discriminate. Investors pretend not to notice because pretending allows them to stay comfortable. A serious crack forms when insiders quietly change their behavior. They sell a little more, hedge a little more, talk a little less. They won't announce their concerns. They simply act on them. Investors ignore these subtle shifts because it's easier to trust headlines than human behavior. Another overlooked crack is declining transparency. When explanations get vaguer and disclosures get thinner, people should be alarmed. Instead, they rationalize the lack of clarity as strategic communication. That kind of denial always ends the same way, painfully. Cracks also appear in the form of slowing cash flows masked by enthusiastic presentations. You'll hear big claims about future possibilities while the present quietly deteriorates. People focus on the fantasy because the reality feels inconvenient, but the cracks don't care how you feel about them. Over-reliance on debt is another crack investors refuse to inspect closely. Leverage hides fragility until stress shows up, and then it exposes everything at once. People avoid examining this risk because it forces them to confront how vulnerable their favorite ideas really are. You can also see cracks in sectors where enthusiasm remains high but actual demand is softening. Optimism lingers long after reality changes. Investors cling to the old narrative, hoping it will become true again. Hope, unfortunately, isn't a corrective strategy. Another crack emerges when innovation becomes marketing instead of substance. When companies talk more about potential than performance, that's not growth, that's distraction. Investors pretend not to notice because potential sounds more exciting than discipline. Strange price movements are another warning sign. Assets begin behaving erratically without clear catalysts. The patterns don't match the explanations. That's a crack investors cover with stories because they'd rather maintain confidence than investigate inconsistency. Cracks also form when people start stretching their justifications. They move from "this makes sense" to "this should work out if everything goes perfectly." When optimism requires perfection, the risk is already extreme. But investors overlook this because perfection always sounds more plausible than uncertainty. You see cracks when businesses start relying on adjusted metrics instead of real ones. Adjusted earnings, adjusted losses, adjusted expectations. The adjustments pile up like excuses. Investors ignore the pattern because adjustments temporarily protect their narrative. An important crack appears when people stop reacting to bad news, not because the news isn't serious, but because they've become numb. That numbness is a psychological crack, a sign people have grown too comfortable to recognize deterioration. That is extremely dangerous. Another crack shows up when management teams speak in abstractions. They replace concrete figures with inspirational language. Investors interpret this as vision instead of a lack of clarity. But vision without reality is just fog, and fog hides cracks very well. Watch for cracks in sentiment, too. When people respond to questions with irritation, sarcasm, or blind dismissal, that behavior signals fear underneath. Investors pretend not to see emotional shifts because emotions don't show up on spreadsheets. Cracks also form when markets punish good news or reward bad news. That inversion signals the underlying psychology has changed dramatically. People ignore it because it contradicts their belief that everything is stable, but when reactions lose logic, cracks widen. Another subtle crack is the growing divergence between long-term fundamentals and short-term behavior. When prices move as if the future no longer matters, discipline evaporates. Investors refuse to acknowledge this because accepting it means confronting their own participation in the madness. The final crack, the one people try hardest to ignore, is the loss of skepticism. When nobody challenges anything, that silence is the loudest warning of all. The absence of doubt creates the perfect environment for disaster, and by the time people finally see these cracks, the damage has already begun. The uncomfortable truth reshaping the entire playing field is that the old assumptions people relied on no longer function. The environment has changed in ways most investors haven't even begun to process. They're behaving as if the same shortcuts, the same habits, and the same lazy reasoning will still carry them forward. But the world doesn't reward outdated thinking, it punishes it. The truth is that the margin for sloppy decisions has collapsed. For years, the market tolerated weak logic because conditions were forgiving. You could be imprecise and still look competent. That era is gone. The new environment exposes flaws fast, and it doesn't wait for people to catch up. Another uncomfortable reality is that the tools people use to feel informed are less reliable than ever. Information is abundant, but understanding is scarce. People drown in data without improving their judgment. They mistake volume for insight. And this shift is showing how worthless that approach has become. The playing field is being reshaped by a deeper psychological shift. People have grown addicted to ease. They want results without friction. They want clarity without thought. But markets don't tolerate that mindset forever. The moment the world demands real reasoning, Most investors realize they never learned how to think independently. A major truth emerging now is that competence isn't evenly distributed. Some investors actually understand what they're doing, most don't. During easy periods, everyone looks similar. When conditions shift, the separation becomes brutal. Skill stands out. Pretending does too, but for the wrong reasons. The new reality also punishes emotional dependence. People want reassurance more than accuracy. They want experts to soothe them, not challenge them. But this shift rewards the opposite. The calm thinker who asks unpleasant questions and ignores comforting nonsense. The market has no sympathy for emotional fragility. Another uncomfortable truth is that people have been leaning on trends instead of principles. They substitute momentum for judgment, popularity for logic, and prediction for analysis. But trends lose all power when the structure underneath changes. Principles survive, trend chasing does not. The playing field is shifting because incentives have shifted. Too many decisions are being made for the sake of appearance rather than substance. Leaders chase narratives to keep investors happy. Investors chase narratives to feel smart. This circle of self-delusion collapses the moment reality intrudes. Another truth, the speed of change has outpaced people's mental models. They're thinking in timelines that no longer match how fast risks evolve. By the time they understand the shift, the landscape has already moved again. Slow thinkers get blindsided in a fast world. The shift is also revealing that most portfolios were built on imagination rather than durability. Investors talked about the future instead of examining the present. They built expectations instead of protections. The new environment is teaching them that imagining success is not the same as earning it. Another uncomfortable truth is that risk has become more hidden. You can't see it by glancing at charts or reading headlines. It lives in connections, incentives, and assumptions. Most investors don't analyze those things because they're not neon signs, they're subtle. And subtle risks are the most dangerous. The playing field is reshaping itself around discipline rather than enthusiasm. For years, enthusiasm could masquerade as competence. Now discipline is being reintroduced as the separator between those who survive and those who get washed out. The shift is uncompromising. Another truth emerging is that volatility isn't the enemy, fragility is. People fear big movements but ignore weak structures. They focus on price swings and ignore balance sheets. The shift is showing that fragility is what destroys wealth, not volatility. The market is also revealing that people weren't diversified, they were duplicated. They owned a collection of assets that behaved the same under stress. That isn't diversification, it's wishful thinking. The new environment is making that painfully obvious. Another truth, investors drastically overestimated their ability to remain rational. They told themselves they would stay calm when things changed. But the moment uncertainty increased, their behavior told the real story. Rationality is not a default. It's a discipline most people never practiced. The playing field is reshaping itself around honesty, the kind people avoid. You must be honest about what you understand, what you don't, what risks you can't evaluate, and what limits you actually have. Pretending you're omniscient used to be harmless, now it's fatal. Another truth surfacing is that people anchored themselves to outdated benchmarks. They measure success by irrelevant comparisons. They look backward for reassurance instead of forward for reality. The shift punishes backward thinkers because the future never asked for their permission to change. The environment is also exposing the illusion of safety that people built through complexity. They thought complicated strategies protected them. They thought clever formulas insulated them. But complexity is fragile, and the shift is snapping those structures like dry twigs. The playing field now rewards patience more than conviction. Conviction without accuracy is just stubbornness. Patience allows reality to reveal itself. But most investors don't want reality, they want speed. This shift is teaching them that impatience has a price. The final uncomfortable truth is this: the world doesn't bend to assumptions. It doesn't honor your preferences, your expectations, or your past successes. When the environment changes, it changes completely. And if you don't change with it, the market doesn't wait. It simply moves on without you. Clear thinking becomes essential the moment old rules stop working, because that's when habits turn into liabilities. You can't rely on shortcuts you memorized years ago. You can't repeat mantras that were only true under different conditions. When the world shifts, the mind must shift with it. Otherwise, you end up solving problems that no longer exist. The first requirement for clear thinking is the ability to admit that your previous assumptions may have been wrong. Most people cling to their old beliefs long after reality has disproven them. They treat adaptation like betrayal, but the world doesn't reward loyalty to outdated ideas. It rewards accuracy. Clear thinking also demands removing emotion from the equation. When people feel threatened, they stop thinking and start reacting. That reaction may feel natural, but nature doesn't care about your feelings. It cares about consequences. A calm mind can navigate chaos. A panicked one amplifies it. Another necessity is intellectual humility. When rules change, intelligence alone is useless without the willingness to rethink. Being smart doesn't protect you from being wrong. It just makes your errors more expensive. Humility keeps your head clear, your ego small, and your decisions grounded. Clear thinking requires paying attention to incentives. Every piece of advice, every forecast, every optimistic statement has a motive behind it. If you ignore incentives, you misunderstand reality. When old rules break, incentives reveal who is telling the truth and who is selling comfort. A rational mind must learn to separate facts from interpretations. Facts are usually simple, but interpretations multiply endlessly. When the system changes, interpretations fall apart first. The people who cling to interpretations instead of facts drift into confusion while believing they're informed. Clear thinking also means discarding the habit of prediction. People think forecasting is insight, but most predictions are guesses dressed up in confidence. When rules stop working, prediction becomes even more unreliable. Better to focus on adaptability than on imaginary certainty. Another principle is resisting the urge to imitate others. When familiar patterns collapse, crowds move even less rationally than usual. Copying them becomes suicidal. Clear thinking means evaluating reality independently, even when everyone else is rushing in the opposite direction. Clear thinking demands that you simplify. Complexity becomes useless during transitions because it depends on too many assumptions staying intact. Strip ideas down to what is undeniably true. The fewer moving parts your mental model has, the better it performs when the world becomes unpredictable. A disciplined mind must avoid nostalgia. People romanticize the past when the present becomes uncomfortable. That nostalgia clouds judgment. Old rules served their purpose when they were relevant. Clinging to them now is nothing more than an emotional distraction pretending to be wisdom. Clear thinking requires evaluating consequences instead of intentions. People get attached to goals and forget the path might be flawed. When the environment changes, intentions become irrelevant. The only thing that matters is whether the strategy survives contact with reality. Another necessity is avoiding denial. Denial is seductive because it shields you from discomfort, but it also blinds you from danger. When old rules stop functioning, denial keeps people stuck in outdated frameworks. Facing the truth early gives you time. Avoiding it steals time from you. Clear thinking means watching behavior more than words. When conditions shift, people say one thing and do another. Their actions reveal the truth. The market speaks through behavior, not press releases. A rational observer pays attention to what people do, not what they claim. Clear thinking also requires ignoring the need to look smart. The moment you prioritize appearances over accuracy, you stop thinking clearly. Real understanding doesn't need theatrics. It needs discipline. People who love sounding brilliant usually end up trapped by their own commentary. A calm thinker updates their beliefs gradually and continuously. Most people change their views only after disaster forces them to, but by that time, the damage is irreversible. Constant incremental adjustment is boring, but it prevents the kind of shocks that wipe out entire portfolios. Clarity demands you question your own incentives too. Your desires, your fears, your pride, these distort judgment just as much as external pressure. Clear thinking requires turning your skepticism inward, not just outward. The person most capable of misleading you is you. Another core requirement is the ability to evaluate paths instead of moments. Most people judge decisions by short-term outcomes. When rules break, short-term outcomes become nearly meaningless. A clear thinker evaluates the durability of the entire strategy, not the temporary noise. Clear thinking means accepting that some things are simply unknowable. People waste enormous time pretending uncertainty can be conquered with more information. It cannot. When the rulebook breaks, the wise mind plays defense until genuine clarity returns. A rational mind understands that survival is the primary objective. When the environment transforms, your first job is not to win, it's to avoid losing catastrophically. Those who aim for brilliance disappear. Those who aim for endurance stay in the game long enough to benefit from the new rules. Clear thinking in a changing world requires stripping away illusions, examining reality without emotional filters, and making decisions based only on what is durable, testable, and honest. When old rules fail, clarity becomes more valuable than intelligence, because clarity keeps you alive. When the landscape shifts, most people don't lose because conditions got harder. They lose because they kept thinking in ways that no longer fit the world in front of them. The rules are changing, the signals are different, and pretending nothing has shifted won't protect anyone. If you want to stay ahead, strip away your assumptions, rethink your habits, and look directly at the facts instead of the stories people prefer. The market isn't waiting for anyone to adjust. Either you think clearly now, or you watch the consequences unfold later.